Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about why two legs are better than one. Not these legs, I'm talking about option legs. So in my opinion, as I've got more and more experience trading options, I've kind of gravitated towards credit spreads, debit spreads, and things like that versus single leg options. So today I want to show you why I think it's a better trade for you overall. If that is what you're looking for, please stick around. Now, when you're first learning about options, it is important to understand the basics of buying and selling puts and calls, how assignment works, all these types of things. Get the lay of the land, and I always consider that like an enhancement to my portfolio. So a perfect example is selling a put, and I'm certainly not against this. You find a stock that you really want to own long term, you activate your money by selling a put at a strike price where you'd want to buy that stock. So you sell that out 30, 60 days somewhere out there, and time ticks away. You might either have credit from selling that put in the first place, or the stock drops to that strike price and you pick up those shares, they get assigned to you. So that's all well and good, and that's how most people get started, and I still do that. However, more and more of my trades are now credit spreads and debit spreads, and if you ever talk to professionals, that's what they do because they want to define their risk. So I'm moving that way. I'm doing more and more that way, and I think it's fundamentally a better way for us to trade if we're going to be in this options market. So today I kind of want to run through an example of exactly how that plays out in my mind, and I want you to tell me if you like it or don't like it. So my example today is going to use something called AAPL, which is Apple. It's an obscure one, I know, but great for our example here today. So earlier in the week, Apple was trading at $173.50. It's dropped a little bit. Now it's around $172.50. But when I grabbed this data, that's where it was at. So at that time, if you sold a 30-day option out for a 160 put, you'd collect about $100, right? That's credit that you put in your pocket right now so you can go get that sushi dinner. But that does require you to have $16,000 of collateral sitting around. So that is one thing to consider. Now, that is the worst case scenario, right? Apple goes to zero. Now, is that going to happen? No, I don't think that's going to happen. But it could pull back significantly, right? I do think that could happen. But that is one thing to keep in mind. You do require a lot of collateral when you're just selling a put to have around. Now, next step. If we went out and we sold a 30-day 160 put for $100, just like in part A, and then we bought a 155 put, that would cost us about $64. So we're taking in a $100 credit, paying a $64 for that put. So altogether, we have a net credit of about $36. Now, in this case, that only requires $464 per contract that you do. So what I'm suggesting, if you want to get that $100 credit, if that's what's important to you, is that you go out and you buy 3 contracts. Okay, so 3 contracts, so 160, 155 credit spread. All right, so in this case, you're going to net out $108, and your max loss is going to be about $1,392. Well, it is going to be $1,392. So already you can see one of the big differences here is that $16,000 of collateral, which could go to zero, probably won't, but could drop significantly versus our max loss that we've capped here. We've defined our risk as $1,392. And if you're not sure where that $1,392 comes from for that max loss, that's simply the difference between 160 and 155, which is $5, times 100 for 100 shares, that's $500, times 3 contracts, which is $1,500, minus the credit that we're taking in of 108, gives us $1,392. So that's where we get our max loss. So if this thing falls all the way to 155 by expiration, the most we can lose is $1,392. If it drops to 140, still $1,392. 130, still $1,392. But if it drops to 130 in our first example, then you've lost $3,000 minus the credit that you collected of $100, right? So now you lost $2,900 there. Max loss for ours is $1,392. So you can see where there's a big difference here as far as the maximum loss that you could have. But of course, that would never, ever happen with Apple. Or could it? In my mind, it certainly could pull back significantly. Just earlier this year, January 5th, 2023, Apple was at $126.60. And I was writing February 3rd, 105 puts, collecting credit. Single leg options, hoping that it was going to continue to fall. But in that situation, I think it was undervalued. And my plan was actually to roll it down to a 100 strike price and try to get it in that double-digit territory when you considered the credit I was collecting. So I had a plan, but of course it took off. Now at 173.50, I think it's a little overvalued. Warren Buffett, he disagrees with me, but in general, I think that's a pretty rich price for Apple at the moment. And I say that with it being my number one holding, or very close. It's close. But that's the situation. And that's why I think right now, if I was going to do anything with Apple, it would be in a credit spread format at 160 or somewhere down there. So that's how I look at that. And don't think it can't happen to plenty of other stocks as well. Flash down again, and look, we have the banking industry, right? Since February 3rd, when this was going to expire on Apple, if you look at the price of KeyBank, Fifth Third Bank, Bank of America, you can see they were trading at those rich multiples. I mean, these are PEs that were still probably in the 12 to 8 range. And now, since then, well, lots have happened, right, in the banking industry. Now we're at $9 for Key, 23 for Fifth Third Bank, and 27 for Bank of America. So these things can get chopped in half really quickly. So in that situation, if you just had open puts that you had sold, bam, you just got thumped. Whereas a credit spread, you're going to be sitting in a lot better position. You would have licked your wounds. You would have had a little bit of a loss, probably a max loss, I'm sure, but at least you would have had a position that was decent. You could go back and reevaluate and decide what you wanted to do from there. So for me, spreads are all about clearly defining my risk and trying to hit more singles than home runs. So in the case of Apple, I have lots of shares, but I currently feel that it's overvalued. I could be wrong, but what I've been doing is I go out and I sell call credit spreads. That reduces my basis overall in the stock if I'm right, meaning the stock stays flat or goes down. I'm going to just reduce my basis and collect that income. But if I'm wrong and it goes flying through the roof, I've got a defined loss there in that credit spread, right? So I'm going to get the gain in the stock, but I'm going to lose on the spread. Overall, I'll still come out ahead if the stock continues to climb. So works out pretty well for me. Another nice thing here is I don't even have to do this on the same platform. So I've got all my shares over at Fidelity, but I found a new platform that I'm exploring that I really like that has reduced fees and really shows off things really well, like iron condors, credit spreads, and debit spreads. So that's where I'm trading a lot of these now, and I'm going to show you that here real shortly. Now, please let me know if I have you convinced, if you're going to start doing more spreads with me. Let me know what you think. Yeah, if you want to be like a pro, trade options like a pro, then follow along. Well, we'll see. Anyway, I really appreciate you watching. Have a great night. Take care. Woo.